best in radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
And welcome. You are listening to the Financial Survival Network, and we've got Danielle Park on. These cycles, are they coming to an end? You know what happens when cycles end? It's usually not a very pleasant time, at least when up cycles turn down. It's never pleasant. Danielle, how are you?
I'm good, Kerry.
Hey, so what do you think? A little near-death experience on the world stock exchanges last week, huh?
Yes, the past couple of weeks, we certainly saw some mean reversion setting into some ridiculous valuations, and all completely deserved, in my opinion. Now, it's interesting that you get such dramatic reversals that couple of days where things were dropping 300 and 400 points. And then all of a sudden you get a lot of Fed officials out trying to reassure everyone that they can still pull more tricks out of their bag. And you get a sort of a reflex rally. But that's pretty typical of these cycles. You know, nothing goes straight down or straight up. You get some big down day. And now we're going back to retest on some of the upside resistance. And we'll see where that ends up, but really good reason for it to continue to the downside after it tests, over the next few days.
Well, you know what I say, Danielle, if you're a big company on the publicly traded exchanges, when in doubt, buy back more shares, especially if you're IBM, right? Can't hurt.
Well, and I know that November and December are some of the biggest months of the year for slated purchases in that regard. So you could see some buying pressure come in, more of the same old that's been the theme of the year. But I would point out that even though we've had record buybacks, and even though that's no doubt led to the increase in earnings per share that we've seen in the past couple of years, that did not stop, for example, the major markets from going to flat returns just this month. It didn't stop the Dow from making a negative return. So imagine what would happen, Kerry, to these markets if all that buyback pressure wasn't present. I mean, if that wasn't the sort of tool of the day to make earnings levitate, it's kind of remarkable markets haven't been stronger given those forces. It kind of shows you the weight of what they're trying to fight against here when they're talking about these extreme valuations that are already present.
Yeah, and there's little to no retail demand. The individual investor is absent from these markets. So what's keeping them up? Do you think central banks are really behind a lot of the increase or the recent resurgence in the markets? I mean, today the market's way up, a couple hundred points.
I think there's a bunch of factors. I think, first of all, there is this huge income inequality, the wiping out of savings following the last recession that have not allowed the average bear to participate to much extent because they don't have much savings. That's for sure. That's one of the socioeconomic factors. So the people who are participating in these markets are either bigger institutions, high net worth sovereign funds and that sort of thing, or highly levered traders. And we've seen a huge amount of prop desks and HFT. You and I have talked about it over time. We know that their margin use or abuse, if you will, is at the highest that it's been, even higher than the 2007 peak. So at the margin, I think you also have central banks involved, and they are buying things. Certainly they've been buying corporate debt and putting liquidity into the system, but I wouldn't put it past them to be buying certain what they consider to be benchmarks. So, for example, the S&P mini contracts are easily purchased to help levitate. And we see a lot of that really suspicious price movements at the end of the day. Now, whether it's central banks doing it directly or through intermediaries that have been commissioned to help with this levitation scheme, I'm not exactly sure, but we do see some very bizarre patterns that tend to come in, at the close of Europe, for example, each day, or at the very last hour of the day on broad markets. And also certain things that people look to traditionally for economic indicators, Kerry, things like the price of oil for a long time there, even as demand has been tumbling since over the last 3 years in the world for things like oil. And you've seen, for example, production surge all over the world, all this great technology that came to us from the overinvestment boom that went on leading up to 2011 has brought all this new energy stream onto the marketplace. So, for example, as I was saying, in the United States, you guys are producing 56% more energy and oil since 2008, but your demand and domestic demand has plunged down almost 10% over the same time frame. So you've got this surge in supply, even as the world is turned down, and yet it's remarkable how resilient the price of oil has been throughout this period. So, when it finally started to come off in the past few weeks, that really was, in my view, a reflection of what the demand dynamic really is. If the price fixers, et cetera, were taken out of the equation. The same thing with copper. It's been remarkable that copper has levitated, no matter how much evidence we find of oversupply and stockpiling and inventories piled to the roof and China warehousing, et cetera, the price of copper has stayed above $3 a pound throughout this period. And I thought that was extremely fishy. And I think that, we're living in an era, you don't have to be a conspiracy theory person to connect these dots. I mean, we're living in an era where every day major banks around the world are being charged, and not just charged, but actually negotiating settlements for admissions of huge price fixing operations. And we're not nearly through that, by the way. There's a ton more of those proceedings still yet to be resolved. So I think it's entirely feasible that those factors have all been forces for keeping asset valuations higher in the past few years, and that as central banks, two things, as they start to pull back liquidity from time to time, which they do in fits and starts, and as they start to lose the confidence game, which this is, then you see true price discovery kick in. And I think that's what we saw in the past few weeks, where all of a sudden things start going down like with abrupt moves and sort of take people's air out of their lungs.
Yeah, well, you got to expect volatility, in manipulated markets, because there's going to be periods of time where the forces, the powers that be, are just not going to be able to control things, or they don't want to control them for reasons that you and I are not going to know, assuming that they are controlling them, right?
Well, the other thing is that when people are this highly margined and this highly involved in prices at these levels, then a decline of, just a modest decline of a 10% correction can cause ripple effects across many asset classes that are highly correlated with this debt quarter speculating that's going on. So it's not surprising that you would see, I find this hysterical in the morning, Kerry. If you notice, I don't know if you watch any of the regular suspects, but the Bloombergs of the world and the CNBC. Sometimes when I'm getting dressed for work in the morning, I'll have Bloomberg on, for example. And during the upcycle, it's all the markets are up, and during the heavy losses, everyone's talking about volatility. It's just a scream. It's like no one's talking about losses; they're all talking about volatility. Volatility is normal. Yeah, well, we haven't had any volatility to speak of for more than 3 years here. So that kind of correction phase, the good news is, as Charles Gave was writing this week, the good news is we're likely coming to the end of one of the stupidest economic periods in human history. The bad news is that no one's actually in charge of these prices, and that really abrupt losses are likely to come, over the course of this conclusion.
Yeah, well, what do we say, people? The only thing we learn from history is that we don't learn from history. And, is this any different than any other bubble period where, you just expect a trend in motion continues in motion until it doesn't any longer, and people want to get the last bit that they can get? But what did Bernard Baruch say? I got rich letting the other guy make the last 10%, right?
Mm-hmm. Yeah. And also, if you keep an eye on, I think there's so much noise in the short run, and there's so many talking heads, and there's, all this instant data these days, and internet's available for anyone that wants to look at whatever they want to look at. And I think that can be quite a disservice actually to individuals, because it's very hard to keep their eye on the things that really matter. And no one can time this stuff on a daily basis. Let's face it. I was saying to you, I get a kick out of, devout Christian or born again Christians and market commentators, because they both speak with such certainty about things that no one could possibly know about afterlife and about what's going to happen with respect to market corrections. And, the word that I hear most commonly from the sell side is absolutely this and absolutely that. And we're confident of this and we're confident of that. Tell you what, I'm not very confident of much, certainly in the short run. But one thing that I take solace from is the long-term trend moves. And that's something that, the technical work that my partner, Corey Venable, does is a great assistance to that, but also the fundamental data that we track over historical cycles is a huge help in that, because it's not necessary to get it right on a day-to-day basis. It's right to get the general trend. So when I talk about that, for example, if you look at things like the Canadian dollar, the Canadian dollar secular upturn peaked again in 2011. It's been declining with global manufacturing and global GDP ever since, as has commodity prices, especially the metals, which are heavily used on the industrial side, as have all the venture companies, the oil and mining materials companies. All that is working back towards the recession lows of 2009, Kerry. So I would suggest to you that coupled with the plunging interest rates around the world, which, people will talk about the 10-year treasury being ridiculously low yielding at 2.10, but when you've got the German bunds, when the German treasuries are yielding less than 1% 10-year, and again, my partner Corey did a great chart this week we put up on the blog of the correlation between German and U.S. treasuries over time, and how every time you get a fresh leg lower in one, the U.S. treasury yield tends to fall even lower. So these are barometers for, the most competitive aspects of the global economy, the United States and Germany being the leader of the Eurozone, the United States being the leader of North American manufacturing and production. So basically, when you see that those things are also retesting to fresh lows on the downside, and the trend there is for further lows. When you look at the things like the levels of debt, again, there's a great article I was reading recently in a journal that's come out, Deleveraging. What deleveraging? You and I have mentioned this before, but U.S. total debt to GDP today is now at 334%. Eurozone is 260%, and Japan is 655% total aggregate debt to GDP, Kerry. These are unheard of levels, much worse than 2008. So I don't think anybody should be surprised that you've got a drop in demand for most things worldwide. Everybody's trying to service unbelievable levels of debt, which are clogging our system. Even the decline in the price of oil is likely to, everyone's talking about, well, won't that be a stimulant to spending in the U.S.? Again, back to who's driving the real economy here, the average worker, the average person, the average household. I think, it's great the price of oil is going down, but that's more likely to just let them service their debt better than increase consumption at this point. So there's a lot of these forces which are making for deflation, slower growth, and I think that that's the main trend. And I've seen very little to suggest that thesis is not the dominant one at work right now.
Well, hey, up next, we're going to talk about that dominant trend, but I'll just remind you of a couple of true words of Lord Keynes. In the long run, we're all dead.
FSN Radio. It's all about what's next.
Every week, the show is growing. Would you like to be a part of it? Then go to clubfsn.com and help support us with $1, $2, $5, or $10 a month and get a host of premium content with newsletters dropped into your mailbox, free books, private audio clips, webinars, and much more. Then join clubfsn.com. If you want to get ahead of the trend and ensure your family's financial security before it's too late, go to clubfsn.com and sign up.
The Financial Survival Network. It's all about what's next.
And hey, what about that long trend, Danielle? In case you're just dropping by, we're talking with Danielle Park of Venable Park and of jugglingdynamite.com. So long-term trends, and we're not just talking about trends, that last for a few years. We're talking about trends, mega trends that really go on for like 10 years or more. The technology trend here of displacing workers, of really reducing the need for workers. That's one that's been with us, Danielle, since the birth of the Industrial Revolution. But now with the technology, with robots, with digital machine tools, the marrying of artificial intelligence, we're going to need less of these factory workers. We're seeing it now where, I remember as a kid, you used to have hundreds of workers in a refinery. Now you got a few dozen. That's going to go down. In automobile factories, the number is going down. Every factory that you can point to that produces hard goods is requiring less workers. But then we go into the service economy. Okay, raise your minimum wage to $15, raise it to $20, wind up with kiosks, wind up with digital burger flippers that can produce 360 perfect burgers if you eat that stuff, but perfect, you know what I mean, in terms of the standards of the company's manual for producing these whatever you want to call it. Okay, so we're going to just see that like 45% of the existing workers are no longer required. And where's all this heading, Danielle? I mean, when these workers aren't needed.
Ultimately, let's not forget that innovation can actually bring deflation in a positive way, in the sense of lower pricing. Okay, so the technology revolution, there's no question that has made greater efficiencies that should bring down the price of goods and services over time because of that. And that's actually a positive deflationary aspect. The other one that needs to take place is asset prices need to come down. Because here's the thing, you can say that people have to make this accelerating amount of money every year to keep up with the cost of living. But if the cost of living is coming down, both through innovation, as we've said, in a positive way, through energy savings, because of alternative energies that are available for all sorts of different uses across the grid that bring down people's costs dramatically. I mean, think about the average bear servicing a whole bunch of debt today, driving around in his gas-guzzling car, paying ridiculous amounts of interest on everything, servicing a mortgage for an asset that shouldn't be valued as highly as it is, but for all these inflationary debt schemes that the governments have come up with over the past few years. We're at the end of a 65-year debt super cycle, Kerry, that has increased the asset value, year over year over year by adding on debt. Now in the mean reversion phase, part of the solution is having those values come back down so that the average bear can buy a house for a lot less than he previously could, so that he doesn't have to spend a fortune on heating and electricity because he can access cheaper forms of energy, as an example. And here's another one. If we can get people back to an active lifestyle instead of eating a lot of junk, they're going to save a fortune on things that they currently waste a ton of money on, like healthcare costs, like, medicines and things. So basically, this super cycle coincided with the commercialization and the mediation of all these different walks of life, which basically said to everyone, listen, you need a lot of stuff. You need to borrow money to get that stuff. You need to maintain that stuff at all cost. All these things were very self-destructive to the balance sheet of the individual and to the health of our society in general. So I think that, yes, it's true that we're going to need less hours worked probably in many of the traditional areas, but there's going to be a whole birth of new, smarter ideas. Here's something that I cannot get my mind around, why people are so pig-headedly opposed to the idea that we are transitioning away from the petroleum-based economies that we've only had, Kerry, for the last 150 years. So everyone's talking about how there's no other way, it's not possible. We've been on the earth for 200,000 years. We've had the petroleum era for 150 years, and people are pig-headedly hypothetically saying it's not possible to get smarter than that. Like, it's just mind-boggling. That's not the story of humanity. So I think that, yes, we're going to lose wages and man hours required in certain sectors, but we're going to need less hours and income when we're going into a deflationary cycle where prices move down over time. And also, there's going to be a lot of really smart new areas where we can reinvest in a much healthier way than we have been doing in the past few years. Look at McDonald's sales today, Kerry. Did you notice that they're plunging all over the world? It's actually a positive thing because it means people are moving away from that kind of toxic ingestion of food that costs our economy across all sorts of levels. So, that kind of thing is actually you can say it's a bad trend because it means there's less sales, but it's a question of how we're allocating those resources and what we're spending on that will dictate how it ends up being in terms of the overall health and happiness of the people.
Yeah, well, I couldn't agree with you more. I mean, all you have to do to cut 80% of your medical bill is just basically quit smoking, eat healthy, exercise a little bit, which means walking for an hour a day. It doesn't mean hitting the gym or anything else crazy. And the whole nature of our housing, the way we've built houses, just so inherently wasteful. And I've been a participant in that myself, and unnecessary, and just, think of all the money wasted there. I don't want to get into that. And this stuff that passes for food in our society. What was that movie that you made me watch again?
Which one?
Sick,
Fat, Sick, and Nearly Dead.
Nearly Dead.
I know, fantastic.
Yeah, great story, and really made an impression. And, look, it's within your power just to adjust your diet and really make a difference in your life and not need most of the medical care that you're receiving. So, just do it. Stop complaining about it and do it. And what you're talking about here is change. And our friend Robert Ian, he's made a 34-year career on helping people embrace change rather than fear it. And things are always changing. And it's all about how you perceive it rather than fighting it. Fighting it, it's a losing battle. And that's what we're about here, is helping you just accept it. Go on. It's neither good nor bad. Just accept it and learn how to live with it, right?
Learn how to evolve, right? Because it goes back to this idea of certainty. And I always cringe when they say markets hate uncertainty. That is the stupidest comment anyone could make. The world in its very nature is incredibly uncertain every day. Every human life is uncertain as to whether they're going to be getting home that night and whether, what's going to happen in that particular day. Uncertainty is part of the human condition, but it also means that we have great capacity to evolve over time. And that's what we've always done. And that's what we're going to do now. So, to think that you can keep things the same, to think that the central banks can control all these moving parts, that they can dictate how things will go over time, to think that any one institution or individual can dictate or control or hold things, keep them here. Mohammed Al-Arian was talking this morning about how central banks don't want asset prices like stocks to go up further or down further from here. They just want them to stay where they are because they're afraid, if they go higher, they're already batshit crazy pricing, and they don't want them to go even worse there. And they don't want them to go down because that upsets people. The truth is nothing exists in a constant state of the same. And so, it has to mean revert over time. It's part of the cleansing process. It's part of a healthy realigning of fundamentals with real organic demand in this society, and a lot of savings can be had. Listen, all these corporate structures that take out huge amounts of money and waste them on buying back shares, that's another example of someone trying to keep a valuation where it ought not be. And all that means is that less people can afford things, that the companies have less money to do meaningful investment and evolution in their product line, that, there's just a lot of waste in the system. All these executives being paid 375 times the average worker today. In the U.S., it's an embarrassment. When you look at, 40 years ago, they were being paid 30 times the average worker. So this is all part of this debt super cycle. The economic impasse in the political process, very much the same in my view. The reason that no one's being able to come to the middle and negotiate anything meaningful is because they've been able to use credit all along to have everything all at the same time. The right and the left get whatever they want because they can add to the debt. Well, if you're not in that phase anymore, if you're in the debt deflation phase, then you have to be much more frugal and much more conciliatory and work to the middle rather than demand extreme positions. So I see this as all very understandable in the context of what's gone on with debt. And I think that now we can move towards a new dynamic. And I think it's happening right now. So it's just there's a lot of people fighting for status quo and certainty and calm and all these things which have never been normal for the human animal. It's just not the way the world is.
Yep, I totally agree. And, look, it's the world is an uncertain place, as they say. And if you're looking for certainty and, definiteness, well, the only two things that are definite, as we know, are death and taxes. And hey, in America, if you're part of the 47%, then it's just death. You don't have to worry about taxes. But look, forget about it. And, I was talking to a guy, Jeff Bell, who's running for senator of New Jersey. And he said before, when Ronald Reagan was running for president, and you could have your opinions about him, when Carter was president, it was horrible. The world was coming to an end, just like today. And somehow things got better for a time. So you can't just believe it's going to be the end of the world. On that note, find Danielle's work at jugglingdynamite.com and go to financialsurvivalnetwork.com, sign up for a newsletter, and we'll see you in a couple weeks, Danielle.
Okay, Kerry. Be well.
All right. You too.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.